Hey everyone, in this video, I'm going to bring you one dividend stock that's down 49% that offers you a very strong dividend yield that you might regret not buying on this dip here. So before I reveal what this company is, I'm going to highlight some of its financial metrics like its dividend yield, and then I will reveal what this dividend stock is. So let's get right into it, starting with this company's dividend yield of 6.62%. A very strong dividend yield, although I will caution investors that this dividend yield might be at a little bit of a risk of being paused or reduced because the company is investing in a transition that may cause it to conserve cash and pause the dividend, although I would rate this as a small probability, but high enough for me to mention here in this video. The next thing I wanted to highlight is this company's strong revenue growth. You could see from 10 years on, revenue has grown nicely, some of it through acquisition, some of it through organic growth. But the company's most recent trailing 12-month revenue of 136 billion demonstrates that it can continue expanding revenue whether organically or through acquisition, and it operates in an industry that's likely to grow over the next several years because of demographics, because of the age of the population in the US. This is a healthcare company, and I believe that the demographics are in this company's favor. Healthcare spending is likely to increase over the next several years. Now, the challenge this company is having is why the stock is down significantly. You see, what I have here is its cash flow from operations to sales over the trailing 12 months. And while it operated at a nice margin of around 5% in the years before the outbreak, the pandemic actually caused its cash flow from operations to fall. Now, this isn't the only company to experience difficulties during the pandemic. It was not easy to manage your business, even if you were one of the lucky beneficiaries of the pandemic. It still wasn't easy to manage your business through the violent swings up and down from customer demand. So I'm gonna give this company the benefit of the doubt here because it has operated successfully for so long. I think it can get its act together, and in fact, management has told investors that over the next 2 quarters, in its third and fourth quarter, earnings are going to grow substantially compared to the first half of the year. So the first half of the year, the company had difficulties. Management expects it to get better in the back half of the year. Now, the last reason I'll give on why this stock you might regret not buying it on this dip here is because of the relatively cheap valuation. The troubles this company has had with its profitability and cash flow have caused its price to pull back considerably. And so at this point, you're able to get it at a cheap valuation at a forward price to earnings of just 7.134, the cheapest this company has been going back more than 18 months. So right before operations improve in the third and fourth quarter, you can get this stock at the cheapest it's been. Now, it's not guaranteed that the operations will improve like management says it will, but that's the risk you're taking, and that's why you're able to get this dividend stock at such a cheap price as it is now. So what is the name of this stock? This is Walgreens Boots Alliance, ticker symbol WBA. All right, but that's all I've got for this video. Thank you so much for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.